Oh, really?
So yeah.
Would it be a YouTube? No. Oh, yeah, yeah, it should be on YouTube.
This should be on YouTube, but
I don't know.
can't
I
find
don't know if it was on after the closed meeting, whether it was on YouTube after the closed meeting or not. But Mark, would you have any notes on that to see whether we made a motion? Because there would have been a subsequent recommendation to the board of county commissioners.
Yeah.
So if we made that recommendation, then the minutes here should reflect that we,
I can check.
okay. So I would suggest that we amend the minutes subject to Mark confirming that we made that motion, and that we add whoever made the motion, seconded it, and that the vote on the motion to make the recommendation.
We did.
Okay, I just don't know who made the motions. So if that could be added into the minutes, to add that motion and the recommendation regarding the record keeper to the Board of County Commissioners.
Okay, so do we have a motion to amend the October minutes as Dave has suggested, and the November minutes?
The November, I've got a couple other comments. Sorry.
No, you're good. You're good.
On the November, the overview, it talks about approving the minutes from the prior meeting. Pardon me?
It says bring the minutes from the 12th. That was,
Oh, bring the minutes.
yeah,
And then it says reviewed the previous minutes.
which were the August minutes.
Okay, and I would suggest that after reviewed, if you could put the date of that meeting,
Sure.
so that clarifies what minutes we were approving.
Yep.
And under the fiduciary recap,
Mm-hmm.
the last sentence says Dave will send the counties, you have CREED document.
Yes.
I would strike the word CREED and just say the county's document creating the benefits slash retirement committee. What's our name? Yes, the investment slash benefits committee. That's what was provided. That's the document that was then provided to the Sultans.
Perfect. Yep.
And then on the investment update, the third line down, Dave motioned to move the action item of fund changes to the February meeting. So if that could be changed to the implementation, because I think we did approve the changes.
we did approve the changes to implement. It should say implementation.
Yeah, so if you could change the action to implementation of the fund changes, I think that would clarify what was done. Those are my suggested corrections.
Are there any more discussions or corrections to the minutes for October and November? No? Okay, do we have a motion to approve the minutes October, subject to the amended changes as suggested by Dave, and the November minutes also subject to the changes suggested?
Yeah, I'll move.
Do we have a second?
Make that motion.
I'll second.
Okay, all those in favor say aye.
Aye.
Aye. That will pass 5-0. Minutes approved, subject to changes. Okay, thanks, Dave. Let's see. The fiduciary governance, Soltis.
Okay, we just wanted to start off with the invitation to our conference, which is March 7th and 8th. I've seen a few of your invites or RSVPs come through, but just wanted to make sure you had an invitation to the investment committee conference. One thing I forgot to mention, Tyler apologizes that he couldn't be here today. He's on an airplane right now, so unable to make it. So Brent Moore's here as well. Yeah, and at our conferences, we typically go over new regulation, things happening in the industry. We'll have our providers there, and we also have a few activities. So Thursday's typically more activity day, and then Friday is where we get into the weeds of all the defined contribution plans. Next thing is we have the SIF fund update. So we have a meeting with Prudential tomorrow about our collective investment trust that we went over last time. Remember, that's the target date funds, and we are getting them at a less expensive pricing model. We are trying to make sure we can get those on the Prudential platform. We should have those funds open at Soltis March 1 of this year, and we'll see what we can do with Pru to make sure they're on the platform.
You are approved.
So, so what do we do until that time? Anything? Just wait?
I would say we're still on pause until
Okay.
we get approval for those specifically. When we get to the investment review later, there was one fund that was approved that we are unable to get on the Prudential platform, so we have another fund recommendation in lieu of that investment.
Are there any of the funds that we're able to move on now as opposed to later?
That's
Changes?
a good
Or are we
question.
going to change them all at one time?
Because we're going to a zero rev share, so we thought we would just change them all at one time rather than doing 2 fund change notices.
it.
But we're able
That's
to
right.
make a move now if that's what.
That makes sense.
So we thought we would just do it all at once rather than twice. Great.
Okay.
I think that's it for the fiduciary section.
Okay. Your Prudential, right?
Right. So let's take a look at, if we want to start with how they have the agenda, the 401A plan consolidation discussion is underway. It's my understanding. I didn't get on the initial call. I think you guys had that last week, right, Ralph?
We did.
I was traveling and working with clients last week. I wasn't able to attend. However, we actually have a project manager that's managing that project for us. We'll have weekly calls to discuss all the different things. Right now, I think we're looking at both plans, plan at a glance. We're making sure that there aren't any qualified benefits that need to be addressed. I think we're getting through that. What did he think it would take, about 90 days?
Yeah. about
So
90 days.
what we may do too is we may make all the changes at once, right? So when the funds change, the zero revenue share changes, going to fee levelization, we might have that 401A roll at the same time, so that we can do just one nice communication and then have some meetings for those communications, if that sounds good to the committee.
I think that'd be a good idea. I think the more we do that, the better as far as the communication.
Right.
I wanna make sure
And Lindsay and I
employees-
were talking about how we might be able to address that by a webinar and/or depending on, like, if I'm back, when I'm back here in May, I mean, I can certainly spend the day here and answer questions with Lindsay about the changes and why we're making the changes, and those people that want more detail, I can be here to answer those questions and just be available,
Okay.
okay?
So until the time that we make the change to zero rev share, we will be on the asset, formula until that time, yes?
Correct.
Okay.
And I did share with Lindsay, and I have it with me today. We didn't quite, when we were kind of working on this prior to the beginning of February, we did what we call a revenue disclosure, which looks at how the funds are playing out. And I used 930 assets because we didn't have our pricing model with the new 1231 assets. But I did run that at the new 6 basis points. And so I have that with me. If you want it, when we get into the expenses and things, it can kind of tell you kind of close. It won't be exact, but because it's an illustration, what you might be getting for a true up for 2019, which is coming probably in the next 3 weeks to a month.
Okay.
Okay, so we can talk about that as well.
Well, just for clarification, when's all this gonna happen? I thought we had a first quarter.
Well, the funds have changed first quarter. I mean, the pricing changed first quarter. So we
Right.
are on the new pricing. So all the things that we used to pay for on the old before we went through RFP is changed. So we're at 6 basis points. We won't change the actual way we're doing the funds, the zero revenue share. We have to do that on the quarter. So we aren't gonna make April. So we're gonna do that. So we're gonna target everything to change, the 401A, the zero rev share fund changes, the new funds that we're able to get on the platform, and going to a per account charge, July 1st.
I thought that was gonna be April 1st. Is that changed?
We can't, because it all we won't be able to get it done. I mean, we could, but what we're gonna do is, they're not gonna see, but we're already on a per account charge from a prudential standpoint. So instead of us doing 6 basis points, we're gonna take all the accounts and find out how much it was and keep our 6 basis points, so whatever that equals to. So that's done. The participants won't see it until July 1st. So they'll see it on their July 1st statement in September. Because there's a lot of work that has to go on in the background to get all of this done for the statements.
And could you tell us the status of the agreement, the contract changes for the?
I think they're done, aren't they? Ralph, didn't you sign those? And the new administrative services agreement
Yes.
Carol sent you?
Yep.
They're done and they're
Yep, those have
and
been
they're
signed.
countersigned, right?
I believe so.
I believe so too.
Oh,
You wanna double
So
check?
from a pricing standpoint,
Rob.
the 6 additional meetings, the 6 moving to 6 basis points,
right.
and the per account charge, or actually the $24 per account charge times how many accounts you have was done 1/1 in the administrative services agreement. So that's done.
But didn't the guaranteed interest account go up?
Correct. Well,
That's already happened.
we took the wrap off of that as well, and that's happened too. Yep, 1/1.
Because we did get a notice,
Right.
at least I got a notice, I'm sure everybody else did, on
Yep.
that, and also that the funds were gonna be combined.
Mm-hmm.
And, a few other things, one notice.
Yeah, there's a lot of regulatory notices, and that's why I'm thinking it makes sense for us to do a nice communication piece that talks about, and then have it happen all at the same time, so that we can gear up for any kind of questions participants may have.
thanks.
We had the commissioners approve everything they needed to approve for this, and they,
I believe so. Everything as far as the fund changes and the revenue share was all taken to the commission and approved. 401A merger was approved. As far as I know, everything that we had
now it's just timing.
this time.
Mm-hmm. And like I said, we could have done it April 1st, but it would have been a lot of piecemealing things. So it is really cleaner to make sure we have it all done in a nice communication, education type around it as it rolls out. So, the quarterly ERISA account overview is in under tab 2. We won't go over it, but I did include it. Ending balance as of 12/31. On page 16, a little over 58,000 currently. The other thing that I wanted to mention about the ERISA account and expense allowance, currently, the way that we are, because we're on revenue share, we've been putting 6 basis points or approximately $100,000. We divide it by 4 and we credit it into the account. That will also continue because we're sharing revenue. And one of the reasons why we don't want to go to a per account charge while we're still sharing revenue is that then they'd get an account charge and we would share revenue and then we'd have to reallocate it back. So what we're doing is we've lowered our prices to 6 basis points. We removed the former advisors' fees. So all of those are going to come back to you from November 1st on in the expense allowance. And then I think the last time we were here, we talked about what you wanted to do for an expense allowance going forward. And it was also $24, which is approximately $100,000. So the total between the 6 basis points that equates to the $24 and the expense allowance that you guys would like to have year over year, that's where the $48 came from. Does that make sense? Okay.
With regard to the reports that you have here, you have a separate report for each fund, right? For the expense account?
Well, what do you mean by fund? Not mutual fund?
No, 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 I mean each plan, excuse me.
I believe that's how she's got it set up, yes.
Yeah, there's 401A, K.
Yeah, and actually, she does, and so then
457.
we'd actually have to make a total. I'll ask her to total those, like we do on the asset page. I'll ask her just on the bottom of that page, just to put all three's totals.
Yeah, if you could do that.
As a
that would-
running
that would-
total?
That way we'd
Yeah.
have a better overview of just.
Yeah, I did
what's
notice that.
happened.
So that was the 416 balance, actually.
That was the
Yeah, okay. So I'll ask her to total those.
That way we could see what the total of the, you know, the total of the three accounts.
Yep.
What the expenses are to date and what we paid out,
Because everything
Total.
kind of comes out of all three plans pro rata.
right?
Okay. I'll have Carol do that for us. So the combined assets, at the end of 12/31 are on page 7. Combined assets were just a little over 147 million with the three plans broken out below. I went out and did pull the balances because we did not have the, bang-up quarter, 12/31. So it has gone up since then, so I like to bring good news. The good news is the total assets now, as of Friday, February 8th, are sitting just above 157 million. So it's rebounded pretty well. The exact total is 157,048,471 dollars. So much better. And then the participant counts on the bottom just really help the committee talk about how many people have plans, and I guess it's even more important now when we see we've got a per account charge. Those will be going down at, as of the end of 12/31, there were about 500 active participants in the 401A plan that will be getting their dollars merged into the K. So that 500 people will have a $48 a year savings for that particular plan. If you want to move to, let's see, page 23. Very quick, we'll just talk about total number of active participants did not change. Terminated went up just a little bit. Suspended participants went from 5 to 3. Now remember, we do have the ability with the new ERISA laws to not have suspension anymore for retirement, for hardship withdrawals. We talked about that, Ralph. The final legislation either is just out or is just coming out on that, and so once we know what that final regulation looks like, they'll be updating your plan documents for that. So that number should go away. So in the plan, at the end of the year, we had just over $56 million in the for people 50 and older. So that kind of shows you that, you know, the majority of your assets are sitting in what I would consider people within 10 years of retirement, right? 10, 15 years of retirement. So again, as we work through some of the things that Prudential and Soltis can talk about for those pre-retirement people, we'll make sure that we target that for you. You can kind of see some of the distributions are staying relatively smooth year over year. Right around just over $6 million. So, you know, that's a nice number to see. You had just a little bit more assets distributed this year than last year. And then you can see the difference in total participant balances. And again, that's a 12/31 number, so a lot of that was market adjustment. If you want to turn to page 27, you can see kind of how we've broken everybody out by age brackets, and then you see in 55 to 64, you've got 30, almost $30 million, and 31% of your assets sitting in that group. So as we look forward to helping some of those people to their day one, we'll make sure that we address that. Now, again, we have participation rate, and this is something that we get off of the system. Sometimes I know that when the prior HR director was here, she always thought that 80% was a little low. But because we don't do testing, it's hard for us to with all the people moving in and out throughout the year, it's hard for us to get an exact number of participation, but I would say that we're probably only off 1 or 2 percentage points. So again, you know, that is something that we always like to encourage, and I know Lindsay probably talks about it in her meetings, is that 6.2, they shouldn't be opting out. They should make sure that they are participating so that they're getting that Social Security offset that you guys give them in a match. So according to our records, we have 203 people that are eligible but not enrolled. And then if you look on the next page, page 30, it just shows you we've got almost 60% of our population sitting right at that auto enrollment number. And then the website said that the auto enrollment number is at about 6.9% is the average deferral rate as of Friday. So the next page, the retirement income calculator, I don't know if we even got to chat much about the new financial wellness website. That's the new landing page when you go on to look at your account. So it's got lots of information, lots of tools, lots of things that you guys can, your participants can take advantage of. And then up in the corner, it would say to your accounts, and you click on that, and it takes you over to the investments and what your contribution is. I have some stats in the back of the book we can look at. It's very minimal because I think you guys only came on November 1st or around that time frame. So we don't have a lot of stats, but we will start including those. So you can see, you know, what your participants are clicking on, what they're interested in, what things can we help them work around with Saltus and ourselves. But the one tool that I've always thought is pretty powerful is this retirement income calculator. So year over year, we had 223 people go in, that we call those unique completions. And then 318, so the difference between 318 and 223, you know, those 90 people or so went back out and gave it more information, said, oh, I don't like how this turns out. And if to remind everybody what that is, that's that green, when you log in and you land in the investments, it's that green bar on the left-hand side that says, what is your monthly income going to be in retirement? That's this. So what I always find powerful and impressive is that people are using the tool, and of the 223, 67 people went in and said, hey, I need to contribute more. And that was, you know, something they did on their own. It wasn't a postcard or anything that we, you know, would send. It wasn't any HR time or Soltis time to have to build that. That was something that they just did on their own. So that's a great number, and it continues to move the needle. If you want to turn to page 34, we had 180 people in auto enrollment status. 53 of those went out and either moved their contribution up or down or changed some investment election that pulled them out of what we consider a default investor. And then 18 people within the period, which is the last year, stopped contributing, and 11 people went out before their automatic enrollment came effective and declined enrollment. So again, those are people that maybe we need a little more education with. We might want to make sure that we put something in place that you know, we find out who those people are, and somebody from the county reaches out to them to help them understand that that's really, you know, they're leaving 6.2% of their money on the table by not contributing. So any questions so far?
Yeah, I'm just wondering, how can we find out, you know, who those employees are, the 18?
Carol can get those.
Okay.
We can run a report. Brenda, why don't you throw that on the list for one of our Friday meetings? They dropped it, yeah. Well, we had 11 actually opt out before we even enrolled them. And then we had 18 who went from whatever to 0.
So Brandon, I'd like to see, you know, the correlation between, you know, their income and what they're choosing to do. Kind of curious about that.
And these are all active employees, right? I mean, these aren't employees that have left the county or?
No, these are auto enrolled. So these are people that either, so if they went to, so basically so the people that went to 0 are still active employees. Okay. And the people that declined are new employees that got the notice, and the notice says, hey, we're going to enroll you, and you're going to automatically be enrolled. at 6.2, we're gonna match you 6.2, and 11 people said no. And they opted out even before we could even get their first automatic enrollment
They be
contribution.
temporary employees that,
I'm only aware of one employee full-time who called and actively told me he wanted 0% and did not want the 6.2.
yeah,
So I'll pull a report of all the individuals, the other 17, and correlate income, things like that. They shouldn't be time limited, they should all be either part-time or full-time, with a 0.5 to 1 FTE.
okay. Yeah,
Okay.
maybe one-on-ones would be helpful. I mean, they may have good reasons. It's hard for us to think it's a good decision.
We can talk about
but-
that, Lindsay,
yeah.
if that helps to have that report. So you're here a couple times a month, right? Once a month. We'll talk about how that best works.
Maybe we need to promote why 6.2 is so key to the 401K for the county.
Right.
We haven't done something like that in a while.
Yeah,
Did we go over that in the orientation, explain why the 6.2?
Yeah,
The fact
we
that they're
probably
not,
should highlight it, we're doing it Thursday. I mean, we do talk about it, but we probably don't highlight the importance of why they should maintain it, keep it, and not go less than 6.2.
and sometimes it can just get missed or misunderstood, or, so I think one-on-ones, when it's this critical, is probably helpful. They can still decline, but at least we know they've heard it directly.
Well, and I know at the benefits fair, in the last 5 or 6 years that I've attended, we do get some people that are closer to retirement that either forget that they aren't contributing to Social Security because it's been a long, long time, and are pretty disillusioned by the fact that, there's not a whole lot there because they've worked, for 25 years here. So I think it is important to people, and at least that way you can kind of feel as a committee you've done your due diligence to make sure people understand
Yeah,
that that's really what that is.
Well, if you look at it as 100% plus the investment results, return on your money. I don't know why anybody wants to.
Well, you and I both know our Social Security is sitting in some phantom trust somewhere, right? We don't have that kind of return. So,
There's not any place else you can get that kind of return on.
not on Social Security. So, I don't have a whole lot more. I think it's more important that we get to some of the things that Soltis needs to get to. However, the last page that I think I'd probably want to talk about is just kind of looking at Goalmaker, and because that is your default investor. So on page 47, in this particular plan, we have just almost $35 million of the 95 in Goalmaker. We've got 669 people utilizing the tool. So that's over 50% of your population using Goalmaker. And then it's over 36% of your total assets in Goalmaker as well. So to refresh everybody's memory, that's the asset allocation tool that you go in by your age and your risk tolerance. And it kind of is a set it and forget it type tool. And it utilizes all of the funds that you have in your plan so that when the investment advisors and the committee change out investments, it really doesn't change anything inside of the Goalmaker itself. It just replaces one fund with the other and then continues to go. If you look at the next page, it just talks about how many of those people are default investors, meaning that they haven't ever done anything and gone and done anything with their funds in the plan. And right now, as of 12/31, we had just over 350 people that are just gone into the plan, kept their match, and are just going. So that, sounds like that's not a good thing, but actually it's a very good thing because those people are getting their match, they're putting their money in, they're getting their match, and they're getting some asset allocation within the tool. So, that's good as well. And then the only other thing is, if you wanted to, because we're moving the 401A, we can take a look at just the plan demographics page, which I had marked, is on page 56. So you can see kind of some of the statistics in that plan. 504 people are in there. Some are obviously terminated. 324 active and 179 terminated. We have a large portion of those over 50, which would make sense because it was much more utilized back, years ago. The other thing is, there's loans available on the 401A, I believe, and I just wanted to make sure everybody knows how those loans will be moved over. So the one thing that question had come, I believe, to Ralph was, I take a loan out of my 401K, I take a loan out of my 401A. So that is one, what we would consider a downsize of, or, the downside of merging the plans is that they'd lose that 401A loan, meaning they wouldn't be able to take it out of each plan. That loan is gonna move over, so if they have an existing loan, it's gonna move over, and inside of the K, you'd be able to have two, but just until that grandfathered loan gets paid off, and then it would just be the one. So we'll wanna make sure that we do plenty of communication around that as well, but I wanted to make sure everybody was aware of that.
So they would have a larger balance to take a loan from, though.
They would,
Correct?
but we don't always,
I
they
know we don't wanna
would.
encourage that, but I mean.
Yeah, exactly. So those people that it affects, we'll make sure that between Lindsay and myself, we'll make sure we talk to those people and have them, and the people that do have loans, we'll make sure we do a communication to them so they understand how that's gonna work moving forward.
Is there any, implications of the, 10 or so, post-retirees who are still getting a contribution into the 401A? Those contributions will just,
I think we'll set up a separate source for them.
okay,
I would think that, I believe, so now you're testing my memory, but there was a phone call we did last fall with the documents people at Pru and then us, and I think we addressed that. And I think what we would do is there would just be a contribution source for those people who still get a contribution, and that would go into their own bucket of money, right? Just another source that you would have to put into Workday. So that's probably how that's gonna work until they phase out.
okay. I was curious if you'd be able to just, at a high level, go over the, tuition assistance.
Yes, I have that. So if you go back to tab,
I realize it's not on the agenda,
Eight.
but,
but I do have it. Page 142. So student loan assistance is on our web tool, right? So you click into it from the financial wellness site that you have now. It's going to be available this quarter, and there's two versions of it. So the first version is, well, if you turn to page 146, it's Vault Advisor. Okay, so that's what's going to be available to all your participants at no charge. So the web tool, the impact calculator, so it's going to be able to feed in. So I guess kids have student loans from lots of different places now. We didn't ever have that when we were in school. You had like two places. But you can put in all the different loans from all the different places you have, and there's an impact calculator. Federal loans will be easily updated and automatically loaded. And then there's one-on-one help and education. And so basically what it does for you is it can help them lower their payments, it can help them consolidate their loans, refinance their loans, see what competitive rates are out there. I know a lot of times you get out of school and they put it all together, and there's our companies that'll actually reconsolidate it and take it out a little longer so that it's affordable. This tool will do that, and it's free of charge to all your participants. If there's any parents that own the loans, they can use this as well. It doesn't have to be the student. And then the other one is the next page, the Vault Pay, and I think that's the one Josh had asked for me to review. So this actually is it's an employer student loan contribution benefit together that if you chose for either recruitment or for another additional benefit that the county might want to offer, maybe new people into the county. I have a couple of plans that are looking at doing a $50 contribution every pay period to help them pay down their loans as an extra benefit. We can help that as well through a payroll deduction. So if you wanted to do it on a match, and where it's really starting to be really popular is in some of the tech companies, because they're getting so close to what everybody is offering, is that they really start looking at the benefit. Well, what's your match? How much do you pay for your medical? Here, a lot of the tech companies are actually giving like $100 or $150 a month to students to come work for them and help pay down their loans. This would be available, well, it does have a minimal charge to it. It's about $26 a year per contribution that you would do. So just, roughly a little over $2 a month is the administration fee that, actually, the company is called Vault that we're working with, and it goes directly to Vault to administer that, so. And then the rest, if you have more questions, it's kind of a slideshow, so you certainly at your leisure, take a look at it, but, both of those, so advisor free to them, the tool is free to them, they get to use it. If you did want to, in the future, offer an offset contribution for those recruitment, of younger people, or for, again, people that are managing their children's loans, that can be done through payroll deduct.
Is that a qualified plan? Is it, tax advantage?
Well,
or
no,
how
I
does-
mean, this is just a service. I
Okay.
mean, there is a level of, if you're in an ERISA plan, you guys are not ERISA, so it really doesn't matter. You can actually set it up so it's a non-elective contribution. And that, then it goes into their profit sharing, right? So you do an additional match and it would go into their profit sharing. And then they would set it up in here that they would be paying down their loans, and then that would go as a non-elective contribution. We can talk about if that's how you'd rather do it, then if you'd rather have it as a non-elective contribution going to pay to, so the incentive would be, you're paying down your loan, so we know you might not be able to afford the 6.2. We'll give you 2%, more into a non-elective contribution if you are paying down loans.
Got it.
And you can do it that way as well.
Okay.
Here's kind of a general question. Have you ever seen a government entity set aside a pool of funds that would earn a return, and the return would be used to help benefit the employees? You could even tie it maybe to the budget goals that they achieved. I mean, private sector companies do this all the time, but have you ever seen a government entity try to do anything like that?
I can ask. I work with Carol, who's our CSM,
Yeah.
works on the state of Hawaii. And so I can ask, and she works in the government union. I can shoot out an email to her and see if she can survey some of her government and teammates to see
Yeah,
if they have
'cause
anything like that.
Sometimes if you go on a year-by-year basis, it just never happens in government, but if there was, some funds set aside that could actually earn a return and
I
use.
think where you're running into problems with that inside an ERISA plan is that there are some things you can use with expense allowance through ERISA plan, and there's some things you can't. It has to be for the benefit of the employees. So a good example is what you can't is if you are resetting your document and building on amendments that aren't required by law. That's a settler expense, and you're not allowed to use participant funds to pay those down. If it's something, a lot of attorney fees are now starting to get real picky about whether you can use the ERISA account to talk about, like if your committee sued or something, talk about
Yeah,
whether or
I'm
not you
even
can use
sure
those
this has
dollars.
to be a retirement-related fund, but.
It could be more in like a health insurance side. There's, I have companies that do if you take this quiz and you commit to do something healthy, we'll give you $150 or something. I have a lot of companies that do that, but it's not inside the retirement plan,
Right.
so.
Okay,
Any other
thanks.
questions? And then the only other attachment I did put in here, because I know that there still was some questions around the per account fee and the fee levelization, is the last tab on page, it'd be like 153. It's just talking about what fee levelization is. So we've got a lot of things going on with our pricing, right? We're moving from an asset-based fee to a per account charge. We're moving from revenue share to zero revenue share. And we're also doing what we call fee levelization. Why that's important is that there could be a time where, and this is also kind of going out because mutual fund companies are figuring out that it doesn't make a whole lot of sense to have a revenue sharing fund and a zero revenue sharing fund, and the revenue sharing fund actually net is better. So they're starting to figure that out, and they're starting to open up share classes that doesn't do that. But until that happens, there are some funds where you cannot get rid of the revenue share, and that fund actually is has a better price once you start looking at net. And we will be putting this in place into the plan as well. So I'll just throw out an example. Certain bond funds haven't been able to get there yet, so we would use a bond fund that maybe had shared a little revenue, 10 basis points. I'm just throwing out a number. So in that event, those people that are invested in that bond fund on a quarterly basis would get that whatever dollars that belong to them that was in revenue share put back into their account, instead of at like today, we're putting it into the expense allowance.
Well, the fee structure that we adopted already provides for that.
Well, we haven't implemented it yet.
Right, but I'm saying.
correct.
Just only subject to being implemented, but
Correct.
the
Yes.
structure we have says it goes back to their account.
Right. So as far as PRU's concerned, zero rev share and plan levelization are two. Some plans don't take it. Some plans say, we're not gonna mess with it. We're just gonna do zero rev share. And if there is any revenue share, they just dump it in the RISA account. You guys voted on it and said, yes, we're gonna do it, but I had some questions come in from different people about how it works, so I just wanted to include it and remind everyone.
Great.
Okay?
Okay, great, thanks.
Okay.
Okay. So, participant support and education?
We have the investment review first.
Oh, yes,
Yes.
yes, you do.
Right? The reason we're here.
Trying to skip forward, so.
One thing, Mike, I don't know if you've ever met either of us, but I'm Lindsay with Soltis, this is Brent Moore with Soltis, so happy to have you here. Okay, so we're gonna start on, let's see, what page number?
Do you want to come up? Okay, okay. Okay, next time.
23 and 20, let's start on 24. So on 24, you're gonna see the previous year, the account balance for the 401k to where it is at 12/31 of 2018. Like Kelly mentioned, December was the worst December since 1931 or 32, 31. So a little bit of volatility in the markets.
But January was the best January since 1981.
Yeah. So just a little bit of volatility. Right. So I know I was out Christmas Eve. I was all worried that I was going to have 1 million participant calls because the market was down, the stock market was down 5% that day, and I had nobody call in. So I guess people were focused on what really matters most that day, right? So you can just see, like Kelly mentioned, the numbers for the plan assets have gone up since the 12/31 numbers. One thing I just wanted to point out is that we have the weighted expense ratio. So taking all the funds or how your participants are invested and their weighted expense ratio that they're paying, so the fee that they're paying to the mutual fund companies is 0.63, and currently the weighted revenue share is 10 basis points. So moving forward with the zero rev share, we should anticipate that weighted revenue share number to go down, and then also the revenue share to eventually be eliminated, just to note those. You can see that on the 401A plan, the weighted expense ratio of 0.44 with the weighted revenue share of 10 basis points as well. And then on the 457, we have that at the bottom as well. So 0.58 for the weighted expense ratio with 10 basis points of revenue share.
You know why the percentages are different by plan when the investments are?
Yeah, that the people that what they're investing in is going to have a different fee. So
Yeah.
you might see a few more people in the stable value fund versus the other funds, but that's a great question. Okay, just to recap how we score the investments. So if we go to page 27, so from a quantitative approach, right, we're looking at the 3 and 5 year numbers, and we want them to be above their benchmark. So we're comparing apples to apples, as well as we want them to be in the top 30 percentile against their category peers. So if they are off on both of those accounts, then they're going to go on quantitative watch. Then we also look at qualitative, just to recap. So we're going to look at, if they're a small cap or a mid cap fund, making sure that their fund size is appropriate. We're also going to look at their Sharp ratio, which Sharp is the risk that they're taking on for the return that they're receiving. So we want to make sure that the risk is appropriate for the amount of return that they're getting. We're also going to look at the expense, right? We want the expense to be average or below average when it comes to fees. And we're going to make sure the manager tenure, so the manager, if there's a lead manager shift, we want to make sure why that manager left, if we have, conviction in the new management. And then we're also going to look at their investment strategy, right? So if they're a large cap stock and they start buying small cap stocks, that's going to be a red flag for us. So just to recap, the two different approaches that we go through. So I think Brent's going to help me out with the funds that are on watch.
Linz, could we jump back to page 5
Oh, sure thing.
and just walk us through, because we've already approved fund changes for several of these managers, but due to what we've talked about with some trying to line dates up for the changes, so if you'll walk us through that.
Sure. Yeah, so some of the funds that we'll see on watch, which the Janice Henderson bond fund is, will be replaced with Metropolitan West. So that will happen.
And that's been voted on and approved.
Correct. Yep. And same with the Investco. That one's been approved. And I think the JP Morgan is another one that's on watch. One thing that we're going to note is that we had the fund edition of the Grandeur Peak Global Stalwarts. That one we're unable to get on the Prudential platform. So our recommendation is, instead of that one, to put in the Oakmark International Investor Fund, which we'll go over a little bit later. But just note that, like Brent mentioned, some of these funds are on watch, but they will be replaced in the upcoming months.
Okay, I think we'll jump to page 20, back to page 28, sorry, but you guys are probably way ahead of me, but I just wanted to remind us of that, those funds that have been approved and voted upon, and the addition of the T. Rowe Price 2060 fund for those that are really young. So going through the managers, obviously Janice has been voted upon and will be replaced. Invesco, JP Morgan, and the large cap. So if you jump to international, we have the American Funds Euro Pacific Growth Fund, which obviously is very growth oriented, meaning stocks that are higher PE ratios, better growth prospects, more focused on some of the sectors that are growth sectors, technology, et cetera. The decision was made to put in the Grandeur Peak, which would have been a nice complement to that fund in terms of size of the companies. So smaller size companies versus larger size companies. But we're not able to, at this point in time, add that fund on because of some reasons at Pru, which is okay. We'll go to another manager. And the other manager that we've selected to do the replacement with is Oakmark. And Oakmark's another fund that is usually in our lineup with Grandeur. So this isn't a sub fund like, well, this is our second or third choice. This is typically we have Grandeur and Oakmark in our portfolios. The reason that Oakmark will be a nice complement, you are going to be dealing more with large companies, so both managers will be in the large cap space. But Oakmark is very value driven, and so is the manager. Mr. Hero was very focused on stocks trading at a discount. Go Google Warren Buffett, and you'll learn all about the theory behind what this manager does. We're very excited about the opportunity of the timing of this fund. This is a fund that has historically been a very, very strong 10-year plus track record. But because of his value nature, a lot of times value managers will go into areas of the market before the returns come. And they're looking at depressed stocks that are undervalued. Sometimes they get to those names before the overall market does. So if you look on page 40, if you kind of keep your finger there, what we've done is we've put the information on Oakmark International into on this spreadsheet. I'll pay note for those that can see here, this upper left-hand portion that shows us 1 year, 3 year, 5 year, and 10 year, Oakmark being the green bar. You can see over the last 10 years this manager's ability to provide outperformance. Please, I guess we're asking here for a little bit of confidence and some trust here. This manager had a very, very difficult 2018. We've seen Oakmark have this situation before where they have a pretty significant miss in a year, and we are very excited to add this manager, I guess I would say, at an opportune time where his favor's a little bit out of style, but one that we have high conviction that will come back very quickly. We added this into a lot of our other plans earlier last year, and so we were a little bit early, but it's still a manager we have high conviction on, and timing-wise, we are very excited about the timing to get this into your plan. So, any questions or comments? Do you want to kick me because of, we're coming with this manager that maybe doesn't look all that great right now?
So this is a recommendation to turn the lights off. This is a recommendation to replace the fund that we can't get on.
The
platform.
grandeur.
And you feel that it's a similar fund as far as the function and the.
They're both Grandeur was more small-sized companies, but it was growth. They have a bias towards growth, and that will be Oakmark. So there'll be a nice complement between the American Euro-Pacific, which is growth, and this fund, which is more value.
Okay. And, the timing of this would be similar to the other funds as far as, and this.
Unless the committee wants to plow through, we can plow these changes through. We don't have to wait. So we'll defer back to you on that. We're more than happy, and I think Prue's more than happy if we want to go ahead and get these changes going. And
So in adding this fund, it's not replacing another.
It's not
fund.
replacing
a new one,
anything.
so
It's a new
nobody's money
fund.
will automatically move into this fund.
No,
They
we.
have to choose or.
Yeah, with one manager in the international space, we'd like to see at least two.
Sure.
And when we go to place another manager in the lineup, we'd like to see a complement of a fund, not a sister fund, if you will, something that, gives more diversification, not two of the same, two growth names and
We're
doesn't-
adding 3 additional international funds, is that correct?
just one.
Just
Well,
one?
there are 2 other Fidelity funds that are approved.
The index.
The 2 index funds, yeah.
Those were already approved?
Correct, yep, there
So
are.
the only one that you need, the only additional one that you need approval for is this one?
Is this
Correct.
one?
Oh, Mark, instead of the,
Grandeur Peak, yep.
The Granger's already been approved, but it's.
But it wasn't.
It's not available.
It's not available. Approved, voted on, but not available, so we've come back and said, okay, if we can't have grandeur, this would be a fund that we would want to see. In conjunction with the other funds, adding, index funds in there.
So ready for a motion? on that
Yeah,
one?
I just want to ask if anyone is feeling strongly about you doing this sooner than later. I would
Go
rather,
sooner.
and I'm more on the side of just doing it all at the same time in July, but I want to hear what everyone else has to say on that.
I'd rather do it right now because, as you see, if you're buying in now after the decrease, if you wait and it bumps up again, you'll have lost that opportunity.
I would agree with that. My question, Kelly, would be from Prue's side, because it's not a replacement, it's just an addition. That's typically a little easier to have done.
We usually, most of our fund changes, even if we're mapping, it's usually between 75 and 90 days.
And if you're not mapping, you're just
Yeah,
adding.
You're just adding, and you're non-ERISA, so we could find out what's the soonest we could get it on the platform would probably be somewhere in early April, is my guess.
I don't see any reason to wait.
But again, you typically do all the regulatory notices and you typically send out all the fund letters saying, here, we're adding this fund. You're non-ERISA, you don't have to do that. You could add this fund and just have it show up because nothing's mapping to it. It's not affecting anybody, right? So we could do that if that's what you wanted, just to get these funds that have no money in them on the plan.
Yeah, I don't have any issue with sooner than later. I just don't want it to hold up anything else that we're trying to do. If we go.
It shouldn't hold
if
anything
we
else
go
up.
up-
It
if
just
we-
might confuse, if we send out letters, and then we send out letters again in July, there's a lot of fund changes, it's completely up to you, though. It's not that we can't do it, it's
Is
how
there
you guys
anything
want.
else that we've approved that would be in the same, category that we could just move on now as well? Why not move on as many as we
The
can?
Fidelity Index
That's what I mean,
international
we could put
funds, we could do those.
the other funds that we're adding, the ones that have no dollars in them, correct?
Correct, like the T. Rowe Price, target
Let's
date
do all those.
2061.
Add all of the ones that don't have a mapping?
Right.
I don't know that you're asking for our vote, but that would be our opinion.
There aren't any workday implications, are they, with this, Brandon? I mean, I don't see, it's just. Yeah, I didn't think so. I just always want to ask the workday question. Always want to ask.
Would we have to have commissioners approve that as well?
We wouldn't have to approve the timing, but we would have to approve the new
Oakmark,
fund.
the new
Have
Oakmark
to be
fund.
approved before which we could do.
Oh, yeah, I just make it all the same recommendation.
But the other funds have already been approved to be added.
So they could,
why
after
would
this
you do
one's
the other
approved, they could
funds
actually
too?
put all 4 of those new ones right into, since they're new and they're not
Change
mapping anything over,
revenue
they just
share.
put them in out there if somebody wants to.
It's just an option, add an option.
No, I don't think it's a bad idea, Dave. Anyone else have any thoughts on that? Moving forward with the funds that don't have to map?
But Oakmark is replacing a couple of funds.
No, it's just an addition.
Oh, there's two
Large
Oakmarks,
cap,
Kim.
It is.
Those are already there.
There's Oakmark Large Cap, and then there's Oakmark
International.
International. They're two separate funds.
So I'm talking about the international only. 'Cause the Oakmark, the other one
This is a mapping.
is a mapping fund.
You're not talking about that Oakmark.
I'm talking
is-
about any of the mapping ones, just the
Okay.
new funds that have no
This
balance.
is this grandeur.
There's 4 new funds, right? If you go back to page 5,
Yeah.
there's the addition of the T. Rowe Price 2060 target date fund. There's the addition of Grandeur Peak, which I'm confusing you because that's really gonna be Oakmark International. And then there's the Fidelity Emerging Market, and the Fidelity Total International. So those 4 funds.
So
And we wouldn't
Kelly-
add, and we probably wouldn't add those to Goalmaker either, right? We'd leave the Goalmaker lineup the same, because that will affect it.
Well, we are not the advisor over Goalmaker.
Right, but I mean, if you wanted to add those asset categories to Goalmaker, it would, but we could get them added now and decide to change the Goalmaker lineup later.
Correct. I would agree with that.
I just wanted to make sure, because I don't want to set a bad expectation so, great.
So Kelly, if we go forward, is it really gonna make a difference in timing? It'll be sooner than the 1st of July, or is it gonna be like the
Well,
30th
yeah,
of
I just
June?
asked Carol, I am there and asked her, I'm guessing, because it's just an ad,
Uh-huh.
so there isn't any, because you're not ERISA, there's really no like legal reason you have to get the letters out in
Right.
in whatever timely manner. My guess it's gonna be, what are we in February, mid-February, end of March, early April? Because then it just depends on our capacity calendar of how we
Okay.
can do the funds.
Can I confuse this more now?
Sure.
I'm never gonna be invited back.
Make a note, Mark.
I guess I would ask the question, if you've already voted on the Henderson fund to be replaced and these others to be replaced, and you're talking about having to send out a letter anyway for the addition of the funds, why not, why don't we just replace the managers now? The ones we want replaced, the ones we want added, and do the manager changes all at one time so that people don't get additional funds, and then, I guess I'd ask that question.
Some of
Kelly.
those will map though, right?
Some of them will map, but, you can figure out the fee situation later.
I don't know, I would
Is it
need,
gonna take longer though? I
yeah,
mean,
Kelly, I need.
We
Well-
don't want to have to push that time period back, I
Well,
agree.
so you've got some existing funds that are revenue sharing now, that you could theoretically push all of them to 0, right? So that could be included in the fund change. The ones that are on our platform that are sharing revenue, we have those that could go on with the ad, right? So basically, you're not mapping anything, you're just changing share class, getting everything to 0.
Right.
We could do that. Then I think what Tyler and I discussed though was that we would wait till we had all the changes So example is they're looking at the T-Row target date funds in their CIF class, right? That's some of the discussions we're having. You have the T-Row price funds already. So we would, if we moved it to zero, and then again, we'd have to move it again when we got, when we were able to get yours on the platform, that's the difficulty. Right? Because right now, every fund just about is sharing revenue. And that's the change.
So it sounds simpler to just add the fund additions. And
I think and to do everything that we're doing all at once, it's a manual process at Pru, and, we could muck it up. I mean, I'm not to say we will, but it does make sense to me. When I've done these, and we've done it in a nice projected time, I have no problem adding funds because they're just gonna be out there, and those people who want to invest in them will go out and invest in them, right? But trying to do do the zero rev, the fee levelization, the per account charge all at the same time, and the 401A is my recommendation, because then it's all together at once. All the changes are gonna be felt at once. I don't think the fund ad would be an issue.
Right.
Okay.
I just asked, I was just, that great clarification, and I don't disagree.
I think we should go ahead with the funds that we can change that don't map.
Those four funds.
Ready for a motion?
All right. So I will make a motion that we recommend to the Board of County Commissioners the addition of the Oakmark International Fund. Lost my page here. And with just an instruction that all those funds that have been approved that are new funds with a zero balance that don't need a mapping, that they be implemented as soon as possible.
Okay, do we have a second?
Is that Kim?
Yeah, sorry.
So Linda,
Okay, so we have a
will you send me
motion.
those four just alone?
Do we need to, specify what those are right now?
I can read them, I've got them up if you
Yeah,
want.
yeah, why don't you read them out so we
It's the
can,
Oakmark International, it's the Fidelity Emerging Markets International, it's the Fidelity Total International Index Premium, and then it's the T. Rowe Price Retirement 2060.
okay.
Perfect.
So we have a motion and a second. All those in favor say aye.
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 Aye, motion will pass 5-0.
Or 6 to 0.
6-0.
You oppose
I saw him say,
it. Oh, you did? Okay.
yea or nay?
So did you say aye? Okay. Okay, if you, it would be nice to get this on the agenda sooner than later. Maybe you could send something to Mark so he could get it on the agenda for next week. Just something really nice and concise that Mark can then put on the commissioner's agenda for next week.
Linz, I go pass back to you.
Okay, perfect. Also included in the report, we add the target date analysis, so it just goes over, in your IPS, you talk about monitoring the target date funds and the glide path, so that's included in there. An updated investment policy statement is provided. There are no new changes because we haven't added any new funds, but when we have new funds.
I will note that we should add Commissioner Ainge to the IPS and replace with Commissioner Graves,
Yes.
because we list the commissioners on that, so.
Okay. Sorry, trying to multitask. We've also included the fee policy statement. We had discussed making a few changes to that as we go to that per account fee. So I think that will be on your guys' shoulders just to see if there are any changes. I think it is fine the way it is, but if you do want to make a change for the fee levelization, we can add that in the fee policy statement. Next, I'll go to education and communication. So I have the 2018 calendar in there. So we went over the I was here, 2 advisors were here September, October, November, December. Now we've moved to the second Thursday of each month. I come and do the enrollment meetings as well as one-on-ones on that same day. It's been working well thus far, and we moved to a new online scheduling software, so we don't have the tedious Google Doc anymore, so that's been helpful. We do have our webinar series. We just had our last one, our first one for this year, January 31st or January 30th. If people want to watch the recording, we can add that and send the link to them as well. Below that, we have just the links for the webinar series that we're doing this year. In September, we're actually going to have a more advanced topic one. So if you want to get into the weeds of investing, that's what we're going to be covering then. The other ones are designed to hit more of a broader audience base. So we've kind of gone through what we think we hear from participants and added those for the calendar for this year. So that's on page 105.
Can I just ask a favor?
Sure thing, Ralph.
The last training you had up in Salt Lake last year, I wasn't
Yes.
able to attend. They said they'd send out a link to that. I've never seen that. Did you make sure I got that link to see?
That is because it didn't record.
Oh, it wasn't recorded.
There was a glitch in the software that time,
You want to
so
recreate it for me? No.
I can send you the slides, or I can just,
That makes
announce.
sense.
Sending the slides would be nice though, right?
Okay, I'll send you the slides.
Whatever.
We could send you slides.
Send them to all of us. You would.
Yeah, that's a good idea.
Okay, that.
You can make it up as you go up here. Have your own comment to the slides.
We'll add that as well. Yeah, so typically we do the ICM trainings in late October and then late January, but because our conference is earlier this year, our next ICM training, like the one that was in November, will actually be in May. So just, we don't have a
Don't have dates for
firm
that yet.
date for that, but that is, just keep it on your radar. We've also included on page 113, right before the appendix, is the fee one-pager that we made for Ralph and Brandon to give to participants if they have questions about going from the asset-based fee to the per-account fee. And so just one-pager synopsis. I know that we've had a few participants that have been concerned about the restructure of the fee, and we were able to have conversations with them and kind of explain how it works, and they actually are well pleased afterwards because for those individuals, it was a fee reduction on the overall percentage-wise. So we're happy to do a webinar like Kelly mentioned together as we converge the 401A and the 401K so that people can understand how the fees are going to be working. And we can record that, and hopefully it will record, and send out a link so that your participants are able to view at a later time. And I think that's it. Any questions on education, participation?
Well, the only thing I wanted to add in was there was some call for more prudential education and communication as well. So Lindsay and I are going to work together with Ralph and Mark to get that on her calendar. She has that monthly calendar. So as you may know, we're doing the webinars, right, Mark? So every month you're getting something from Prudential about a webinar you can sign on to. We're going to talk about how we may fit the Prudential Pathways series in, and bringing somebody on site to talk about some of the different the webinar series that we have. And then, of course, we have 5 additional meetings built in. So we have 6 days now of just education meetings from Prudential that we can talk about how you want to utilize those every year.
Great.
Which we had discussed doing something in May or June, right before all the transition, just to be on the forefront. So you have less questions you have to answer later.
That would be great. That would be
Perfect.
great.
Yep. I thought I could come out just like a conjunction of the May meeting, just stay either that whole day or even into the next day. Set up and just let people know, set us somewhere and let them come in and talk to us. Kind of like the
I like
benefits
it.
fair.
It's a great idea.
I think that's it for our parts. So we'll move to the closed meeting or the the very end.
I had a couple questions, just follow-up items.
Sure.
First, let's see, the electronic meetings, we were gonna get a resolution setting up a procedure for electronic meetings. I don't think we got it on our agenda today, but.
Yeah,
if
so
could
we
follow up, make
can,
sure
yeah, we
get
can
that
set
on our
up
next
call-in
agenda.
infos. Yeah, I thought it was switching
That probably
to,
was something we generate, I don't know that you would.
we get, yeah, you were,
So if we can just make a note and be sure we have that on our next meeting, to adopt that resolution. And we can get one prepared. And
We
then,
can also take that one step further. Lindsay was recommending we go paperless if possible, so in addition to our electronic meetings.
I like the papers.
We'd have to have 3 more monitors up here, that's maybe.
it's okay,
Sometimes
we
things
can,
don't
we can
record.
keep the papers.
We'd
Fair
have to
enough.
have laptops or something to accomplish that.
Yeah, I like the paper, but.
We'll keep it paper-based, no worries. As
The
long as
other-
you recycle.
Yeah. The other item I had was the ERISA budget. I'd like to see us adopt a budget and Ivan, I know you're working on that, is that right?
Yeah, I'm not sure what you're exactly referring
Yeah, can you
to.
expand on that a little bit? Because we
Sure.
already have an ERISA
We have an
account, but,
and we go through and we make deductions from that account throughout the year, and then we
Mm-hmm.
end up with a balance.
Mhm.
But I'm looking at having a budget, so a year
so the
in
known,
advance.
so the known things that you know you will charge out of the expense account
Yes,
is budgeted.
correct.
We
Which,
can work on
So that we have not just a report of what we spent, but a plan as to what we're going to spend throughout the coming year.
Yeah, so if you look at the expense that we have now, we can take those columns and we can, instead of having it past, we can do it for future.
I think
Which
already have
we did
something from
discuss this,
Soltis.
yeah,
We do have a
so-
spreadsheet from Soltis.
correct, yeah, so it will be roughly the $24, well, it'll be the $24 per account for Prudential, and then roughly $20 per account for the Soltis fee, but that could vary year to year, depending on how many participants you have. And then it'll be $4 for administrative, so the registration, I can't remember the name of it that you guys have, it's like $600 per year.
NAGDA fee,
The NAGDA fee, and then the investment committee training fee. So that's the $48 that we had planned to bill annually, that you'll get those $12 per quarter. So that's the budget that we sent to Ralph. But you guys are asking budget questions independent of each other, so I wasn't sure which one you were referring to.
So you wanna take basically that $24 annualized.
So
by
what we
each
should do
account
is we
and
should
budget it
take,
out.
you know, the spreadsheet that you have already made,
Mhm.
and we should just add it into the agenda for next time, so that
Okay.
we can make so that we can approve that as the, 2019 budget. Does that sound okay?
And if
Dave?
you wanna
Yeah,
put
that's
that
right.
in, Lindsay, if you wanna get it so we can put it in this book, like we can put the total of the 3 plans, and then the 2019 budget, it can be
Okay.
right in this book, so that it's all together
That'd
on
be
those
great.
pages, to keep it simple.
Would we adopt it, or would we recommend to the commission that they?
it would just be a recommendation. So I just think it's wise to have a plan in advance of the year as to what you're going to spend during the year, because the income will be fairly fixed depending on the account numbers. And then you
Correct.
just wanna make sure that you're not planning to spend more than what is available to spend.
Which, while we're still transitioning from the revenue share to the zero rev
Yeah.
share, this year will be kind of a little bit
half
of a
and
rough transition, but for 2020, it will be, I think, pretty seamless on the, per account charge. Which, one thing that's gonna show up, which we definitely wanna do education about, is that they'll actually see the charge each quarter
Right.
now. So,
So it's charged quarterly in arrears.
Right.
And one thing that has happened to some prior clients of mine as we've gone from revenue share to zero is that we sort of forget that we now take things in arrears. So it can leave people's expense allowance kind of barren because now we're not applying it till the end either. So I was talking to Lindsay last week and I said, I think it's important that, I know we talked about maybe there's additional dollars in there that we could possibly reallocate. We want to make sure we get through have a couple of deposits put in before we reallocate, so it doesn't leave anybody without anything in the expense budget.
Sure.
So,
But yes, we will add it to the next ICM packet.
Great. Does anyone have anything else? All right, do we have a motion to adjourn?
So moved.
Second?
Okay, we have a motion and a second to adjourn. All those in favor say aye.
Aye.
Aye. Motion approved 6-0.